Welcome everyone to Vested Interest. This is Shane back again for another Stock Pick of the Day video. It is November 20th. Today we're going to look at a subscriber or a viewer's suggestion here, and I apologize. I'm not going to try to say your name. I really would probably butcher it. I'm going to call you Guy. Looks like you're from New York City, NYC there at the end. It says, "Hi Shane, could you cover IGT? It is an interesting company." And that is what we're going to take a look at. It's IGT, and that stands for International Game Technology, out of the consumer discretionary sector, and they are a gambling company. Now, before we get too far into the video, if you could do me a big favor and hit that thumbs up button down below if you find any value in the content. Make sure you're subscribed to the channel. Hit that subscribe button. Join us on this journey to financial freedom. Click that notification bell down below as well so you're notified whenever we put out any new videos. I put out a video every day in the Stock Pick of the Day series here, Monday through Thursday, whenever the market is open. There's also the thanks button down below if you want to buy me a cup of coffee and donate to the channel. Really appreciate everyone who can. For those of you who can't, I completely understand. Times are tough for all of us now. And a special thank you to the subscribers out there. You guys are awesome. The channel continues to grow because of people like you. Now, this is the vested interest stock screener. This is the criteria we're going to run through in this video. We'll check it out at the end and see how it stacks up. It must meet 5 of 8 for this type of company. If it was a financial company, which this is not, it would have to meet 6 of 9. So something like a bank or an insurance company, then it would be 6 of 9. You can read this criteria, pause it here, and look at it at your leisure. And if you want to know more about this company, check them out on their homepage, www.igt.com. That's www.igt.com. That is where I pulled this information from. We deliver entertaining and responsible gaming experiences for players across all channels and regulated segments, from lotteries and gaming machines to sports betting and digital, leveraging a wealth of compelling content, substantial investment in innovation, player insights, operational expertise, and leading-edge technology. Our solutions deliver unrivaled gaming experiences that engage players and drive growth. So it's an online gambling business. That's what they really cover. I'm not sure what type of gambling. They say that it's stuff like lotteries, but I'm sure that sports betting. So for those of you out there who have really gotten into sports betting, now that they've kind of relaxed the regulations on that, you may be using a company that is under their umbrella. I just don't know exactly what companies they cover, right? There's a lot of them out there now. They're popping up like crazy. So I'm sure some of them are under this IGT umbrella here, but that's what their bread and butter is. They're a technology company that provides gambling sources online. Now, the reason we were taking a look at them, down 1.16% on the day. We're talking about International Game Technology PLC, ticker IGT. They are out of the consumer discretionary sector. Closed out the day at $18.75. 52-week range as low as $18.58, as high as $28.82. So they are right up against their 52-week low currently. A market cap of $3.785 billion. So small cap company here. Beta of 1.97. That's a lot of volatility. They are almost twice as volatile as the overall market, and you can see that volatility throughout the day, ups, downs, all over. Looks like big jump up, big drop down, big jump up. So they're a very, very volatile company. You may be able to use that volatility to your advantage if you're interested in investing, buying on the low points, holding off on the high points here, right? That's just one day. I imagine if you clicked on the 1 year, the 6 month, or the 1 month, or the 5 day, you'd see the same type of volatility. PE ratio seems pretty high to me, but I don't know enough about these type of companies. It's $33.48 per share here. If it's growing fast enough, you can justify a high price to earnings if your earnings is growing fast enough. EPS, earnings per share, at 56 cents. Earnings date, November 12th. So we're actually past their earnings date. So it wasn't their earnings date that caused the drop today. I mean, they're just volatile. They probably have drops all the time. Forward dividend is 80 cents. Divide by 4, though we'll see that here in a little bit. So it'd be 20 cents per quarter. Yield is 4.22%. Very high starting dividend yield on this one. Ex-dividend date, November 26th. And the payout will be on December 10th. So, right, if you were to buy them now, you would still be in line for this next dividend, though you need to buy them on November 25th or before. Don't wait till the 26th. You need to buy them at least a day before the ex-dividend date. If you wait till the 26th, no guarantee you're going to get that next dividend. Actually, most likely you won't get the next dividend. 1-year target estimate, at least according to Yahoo Finance, $27.14. So they see some upside from here. They just don't see it quite getting back to its 52-week high here. Jumping over to the right, I like to look at dividend yield theory to see if the company is presenting any undervaluation. To do that, we look at their 5-year dividend yield average, 4.51%. We compare it to their current 4.22%, or over here where it says forward, same number, 4.22%. And since the 4.2 is lower than their 5-year average, that actually speaks to potential overvaluation, at least where they currently sit according to dividend yield theory. Now, payout ratio, I like under 75%. You can see here they're at 142.86%. That is not good. I do not like when a company goes over 100%. Now, it's not as terrible whenever something like a REIT or a limited partnership or something like that maybe goes over, because they typically will be issuing shares of their company to offset that. But for a company like this, unless they're issuing shares still, the payout ratio being over 100% is not a good one. And I don't like companies issuing shares, because typically that means they're diluting you as a shareholder and your shares are worth less over time. Now, dropping down, I like growing free cash flow over time, because typically if a company has growing free cash flow, they have growing dividends to match. Now, going back to 2021 here, you can see $740 million in free cash flow. 2022 looks like a drop down to 582, though we'll cover that here in a minute. 2023, 641 million, trailing 12 months at 724. So overall, a little up and down. I would say if you go to the repurchase of capital shares, they repurchased 41 million in 2021, jumped that up in 2022. So I would say some of this drop in 2022 can be well accounted for in the repurchase of shares, even though their free cash flow went down. So I'm not saying that they went down in 2022, but if you look at 2023, no repurchase of shares, and they're down to 641 from the 740 in 2021. And then same thing, trailing 12 months is down slightly from where they were a few years ago. So I would say they do not have growing free cash flow, though it's close. I mean, they're close to flatline, and there are a couple months left in there's a drop in 2023 for sure, but maybe they're back on the uptrend here in 2024. Now, jumping over to stock analysis, this is another source I go to for information. The previous page was Yahoo Finance. I always recommend more than one source that you should be looking at to make sure the information you're getting is accurate and up to date. Sometimes these sources are behind updating. Sometimes they're just wrong. It happens. And I say that right here, price targets were last updated on July 31st. So again, this one's already, several months behind where their last update was, right? So they have not updated recently at all. Right? So that's why I say you want to look at more than one source. But the last time they did update this, they called it a consensus buy. The 6 analysts that they had take a look at this, they have a low estimate of $23, which would represent a 22.73% increase from where it currently sits. Average estimate of $28.67. That would represent a 52.99% increase from where it currently sits, and was pretty close to what we saw with Yahoo Finance on the previous page. And if it happened to hit their high estimate of $33, that would represent a 76.09% increase. All the while you could collect that 4+% dividend yield as long as they maintained that dividend yield. Now, I like to jump into statistics, look at a company's return on equity and return on invested capital to see how well they're reinvesting their capital back into themselves. So we're going to jump over here and look at ROE, return on equity. I like 10% or better here. They're at 10.88, so just above that. And same thing for return on invested capital. I like 10% or better here. They're just under at 8.28. Got to hit both of them, so no check on that one. EPS growth forecasted over the next 5 years. I like 5% or better. They did not have anything listed, so I can't give them a check there. And I throw in revenue growth, even though this is usually when I do more of a deep dive into a company, looking at revenue growth and margins and stuff like that in their balance sheet and income statement. But I throw it in here anyway. It was not listed either. Now, jumping over to their history, again, they're a quarterly payer. Payout ratio, they're saying 118%. Yahoo Finance had them at 135. Either way, over 100%, not good. They do not have dividend growth and have not had it for a while. If you look down here, we'll see that in a second. Buyback yield is negative, so that whenever they are repurchasing shares, they're not doing it at very opportune times. And shareholder yield is positive at 3.09%. You want to see positive shareholder yield. Preferably, you want to see positive buyback yield as well. Now, they do pay out on the March, June, August, December timeframe, like most companies do, though it looks like maybe they have an off month every now and again. April, it shows here, right, would be an off month. But typically, that's the same payout schedule that most companies pay out on. Now, going back to March 14th, 2022, and I did go back a little bit further, it's been 20 cents for years now, several years, and it remains 20 cents. So they are not raising the dividend, which I don't like. I want a company raising dividends. I have enough companies. I have 2 or 3 in my portfolio right now that are not raising dividends, and I'm hopeful that they will start increasing those raises again. Ally Bank's one. I know that one has not. AT&T, I knew had just cut their dividend whenever I bought it, so it's not raising their dividend. Kraft Heinz is another one. So I already have a few that are not raising their dividend. It's a little frustrating. But that's not a deal breaker necessarily if you're getting a steady dividend and you think that you're getting some price appreciation as far as the stock price, and you're hoping for future dividend growth, I would assume. All right, well, let's jump back over to the screener and see how well this one stacks up. So understand the business, that's where we started. Check there. Growing free cash flow, we had the one down here, so no check. Growing dividend, not growing their dividend, so no check. Dividend payout ratio is way over 100%. No check there. Valuation based on dividend yield theory. Dividend yield theory says it's potentially overvalued currently. It is right up against their 52-week low, so check there. Return on invested capital was a little bit below 10%. Return on equity was above, so no check there. It's got to get both. And earnings per share growth was not listed, and even if it was in over 5%, that would only give us 3, but really we're looking at 2. There's not a lot of green here. It would not make it onto my watch list. I would definitely be doing more of a deep dive into the financials on this one, guy, if you're interested. I mean, it does look like an interesting company. I don't know that there's a lot of competition for online gambling companies like this. Though I am seeing more and more of them now that they've kind of relaxed the regulations around the country on being able to gamble online. So I'm assuming there probably are going to be some more players in this space as gambling becomes more popular with people, especially the stuff like the sports betting. And I know there's always been a lot of people that buy, lotto tickets, and now you're able to do it online. So I just don't see enough here for me to do more of a deep dive. Let me know what you think in the comment section down below. And that is really it for this one. Again, Guy, really appreciate the suggestion there. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. Drop a comment down below. Let me know what you think of International Game Technology, ticker IGT, again out of the consumer discretionary sector. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So just like this one was suggested by Guy, and again, apologize. I just didn't want to butcher your name, Guy. So I'm sure that's not your real name, but maybe you can drop in the comment section how do you pronounce that. Give me a breakdown of that. I just didn't want to butcher your name there. But that is really it for this one, and this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You can't lose money. You should never invest any amount you're not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice and counsel of the certified financial advisor.